Fitch Ratings maintains a stable outlook on the ratings of almost all of the Australian banks that it rates, and has a neutral sector outlook for the market in 2023, with our expectation for earnings to remain around levels reported in 2022. We expect the first half of the year to be broadly positive for the sector, with net interest margin tailwinds still adding to earnings, while revenue will benefit from a full period of recent loan growth. Headwinds are likely to emerge more strongly in the middle of the year. These include asset quality deterioration following the rapid monetary tightening to address inflation, a return to more normalised impairment charges, slower loan growth, and an increase in funding costs. We expect interest rates to peak in the first half of 2023, meaning the tailwinds to net interest margins will decline as the year progresses, particularly as competition for loans remains elevated. In addition, banks will start to refinance the Reserve Bank of Australia's Term Funding Facility. This has maturities of over 180 billion Australian dollars over the next 2 years, and will see banks replace the cheap central bank funding with more expensive wholesale market funding. We also expect this to result in increased deposit competition and a shift back to term deposits from at-call deposits, which will add to funding cost pressure. Housing is a key credit focus, as banks have a large exposure to residential mortgages. Australian households are particularly sensitive to rate movements due to high leverage and a predominance of floating rate mortgages, meaning rate increases quickly flow through to borrowers. Higher interest rates are likely to result in some borrowers facing difficulties in meeting mortgage repayments, and we expect arrears rates and losses to increase for banks. However, this should remain manageable, as we expect unemployment to remain the main determinant of defaults, and we forecast deterioration in unemployment to be modest. We expect default rates to peak below 2% as a result. Our stress testing of bank mortgage portfolios show they are robust to more realistic housing downturns. Stress tests of the mortgage books of the 4 largest Australian banks, which have originated and hold about 75% of Australian mortgages, results in losses that do not exceed 30 basis points of risk-weighted assets, or 10% of pre-impairment operating profit, at a 5% default rate and 30% house price decline, much worse than we expect to occur.